Hello, this is Chad Frantzen, founder and certified financial planner of Authentic Counsel, LLC. Today is July 1st, 2020, and in this short video, we will be providing a market update for the halfway point of 2020, which has been a year like no other due to the COVID-19 crisis and a lot of global unrest that we're seeing in our country and worldwide. So let's jump right into the mid-year update. Again, for more information, you can visit our website at AuthenticCounsel.com. We'll be happy to visit with you, answer your individual questions that you have as it relates to your personal financial planning and investment decisions. This is our standard disclosure. Authentic Counsel, we are a state registered investment advisor, and these charts and slides do represent our personal opinions, and we are not giving, these are not meant to be construed as specific tax or legal advice. We're providing representation from our research and our opinions as we manage clients' finances through the markets as they are currently. Let's jump right in some slides. Obviously, the big pulse on the economy and in the news is COVID-19, and as the economy and markets and cities have started to open back up, we have seen cases start to increase. And you'll see here on this slide that cases over the last 7 days have gone up significantly. You can see where my arrow is here. This track is going up. So we've seen a pretty significant jump just over the last 3 weeks in cases, and so this obviously tells us this, as the economy opens up, that this is the reopening of risk. And so we all have to do our part as individuals and families and business owners, employees and employers, to make smart decisions with what we do, how we do it, where we go, and take the necessary precautions on that. That said, we do think this will continue to be something that we're dealing with for the remainder of 2020. We are hopeful for a vaccine and a cure, but we also realize that those things do take time, and it may be well into next year, 2021, before we see things start to stabilize on that front. From an investment framework standpoint, we wanted to show you this chart to educate you. There are 4 main categories that we look at with our different research partners to get a sense of where things are in the global economic and capital market environment. And these 4 categories are market sentiment, monetary policy, market valuations, and economic growth. And this visual we like because it shows if it's very negative or bearish, it's going to be on this far left-hand side where it is red. If it's neutral, it's going to be down the middle in this yellow territory. And if it's very optimistic, positive, bullish, it's going to be in the green to dark green levels. Of our 4 main framework pieces, monetary policy, which is the specific policies that the Federal Reserve Bank and the United States Treasury are taking to help support the economy, help provide for those without employment, is the most supportive. The other factors for market sentiment, market valuation, and economic growth are all on the negative or trending negative direction. So this is something we take into account as we look at how to manage a family's investment portfolio, what types of assets to be in, and how to manage risk. Overall, the mid-year point of 2020, these are just some highlights, what we call the good, the bad, the ugly. The good, the economy is opening back up after the COVID-19 lockdowns. We obviously mentioned that earlier in our opening slide of that there is some ongoing risk with spikes in cases, and there may be in the coming week or weeks some forms of shutdowns that are done locally or partial shutdowns to help mitigate the increase in cases. Another note on the good, there is leading indicators for the economy. There's an index of those that different research outlets cover, and the key takeaway here is that several of those are starting to improve significantly to where leading indicators in the broad economy, we're starting to see some signs of the recovery taking hold, albeit slowly. Within the markets, there are different sectors and factors that are in a positive trend. So when we look at investments, we look to see, are they in a positive trend or a negative trend? If they are sectors or companies that are in a negative trend, then we may look to remove them from the portfolio or underweight being in them at all. So there are positive trends within different sectors of the economies and some specific companies that we like. And so that goes into our portfolio management decisions. Overall, the global economy is in a recovery. We think it's very slow. It's going to be drawn out. And we will talk about unemployment here in a minute. The bad market sentiment is negative. Despite the fairly rapid short-term bounce that we've seen in equities, we still have negative market sentiment. Within the markets itself, the trends within markets tend to favor defensive positions, defensive asset allocation. We have seen certainly the NASDAQ and technology stocks do very well during this time period. Market internals have reversed and negatively diverged from price indices. We've seen as the stock market has come back up over the last 2 months, we have seen some resistance in those prices, and that's what that point is talking about, a reversal of that. So we do expect that the markets are going to be fairly range bound with where they are. We'll continue to see volatility through the summer and into the election. But overall, we think the market is really going to be trying to find its way in a fairly volatile range here over the course of the summer. The ugly points, economic growth remains negative. Even though we've had some short-term improvements, economic growth is negative, and we do believe we are in a recession, as we've seen a lot of small businesses close or have to dramatically downsize. And while we think the global economy is in a recovery mode, we do think that's going to take a while to get back to pre-COVID levels. So we need to be forward-looking into 2021 as far as a time frame for that. The stock market in the U.S. is at very high levels, and these levels are hard to justify based on the companies and what the companies are reporting and what they're giving guidance for with their earnings. So a lot of U.S. stocks are very expensively priced right now, even though we're in the midst of a recession and a prolonged battle with the COVID virus. So that tells us there is a poor risk-reward ratio. So we're actively managing portfolios and investment strategies with that in mind. A few charts I want to show here. This chart highlights stocks represented by the NASDAQ 100 index in this blue line. And this chart, for reference, goes back to 2000 through the second quarter of 2020. And what you'll see on the blue line, this is the value of stocks. And the red line is what are called continued jobless claims. So this is an inverted comparison. So jobless claims are very high. They're the highest they've been since World War II era on that. Now what we see is a huge disparity. Typically, when you look at this chart, if we go back to 2000, we can see that these tend to mirror each other in that when in 2008, when we had the credit crisis, when unemployment spiked and there was a lot of people unemployed, the markets went down. And as people went back to work, the markets went back up. But we see a huge divergence here, which we believe is the markets, particularly the stock market, is divorced from reality of the economic climate, with a lot of small businesses struggling, a lot of people unemployed, and this is going to take some time to work out. So this is part of the basis for why we believe the markets are just way overvalued in relation to what the true economic environment is. Now, within the markets in the second quarter of this year, and since the markets bottomed in March, the FAM stocks, which is Facebook, Apple, Amazon, Alphabet, which is the Google, parent of Google, as well as Microsoft, those 5 companies, which we call the Big 5, they represent about 40% of the S&P 500. Now, the S&P 500 is the 500 of the largest U.S. publicly traded companies. It's the most commonly followed and quoted and covered index of stocks you can invest in. So if you watch CNBC or you see something in the money section of your paper, this is what it's going to refer to. Now, if you look under the hood of this, 40% of it is these Big 5 companies. So whereas these Big 5 companies have had significant rebounds in their stock prices, many of the other companies have not. And that skews the results of many mutual funds, index funds, retirement dated portfolios, to where we're very heavily concentrated as a investing index in these. So that's not necessarily a good thing. They're way overweighted in these companies, which means that under the hood, things are not as good as they seem for a lot of the major companies in the U.S. And conversely, if you're in index funds, you may not be as diversified as you think you are, which is commonly thought to be a diversified index. It's not. A few more charts here. This chart is put out by Hofstra University, and this is just a chart of valuation on the vertical axis and time on the horizontal axis. Now, what you see is there's different parts of the investing cycle and the economic cycle. And what we would say is that although there's a fair amount of debate on this as far as a V-shaped recovery or an L-shaped or W-shaped recovery, we do believe that statistically the economy and the markets peaked. Let me clarify, the economy peaked in the fourth quarter of 2018 as far as economic expansion, and then in 2019 the markets just continued to go up. And we believe that is represented by this section here where my arrow is. And then COVID was really just the needle that popped the balloon on that. And what's happened since March, particularly in May and June, is that the markets have rallied fairly significantly in a, quote, return to normal, quote, unquote. Now, we do believe there's still a fair amount of downside potential that needs to, what they call a blow-off phase, for the markets to return to historically normal prices or median prices based on companies' earnings for that. So because of that, we do recommend taking some risk management strategies, not having all of your eggs in U.S. stocks. We think you have to be very tactical or precise with what types of investments to be in. This is a high-risk time. Volatility, although I do not have a chart for this presentation, volatility, which is the variability of how much things can be up or down in one day, is at an all-time high. And so volatility is what most often drives normal retail investors like you and I out of the market, because the institutions are behind the scenes, oftentimes controlling things or having insider information or having the inside track on buying and selling. And invariably, it's the retail clients who get bad information, who get fake news, that then make poor decisions and lose their capital. This next chart, I wanted to include it because oftentimes the calls we get from clients is when we're either on the continuum of fear or greed. And so when the pandemic started, you can see here that things went from, we were very greedy overall as consumers and investors at the end of 2019 and in the first couple of months of this year. And when the pandemic hit, we went from greed to off the charts fear. Now, since then, the markets having gone up while the economy has continued to struggle and unemployment is at all-time highs and businesses are filing bankruptcy and people are having trouble paying their mortgages and bills, the market has slowly drifted back to greed, close to the levels of where we were on that. So this is a contrarian indicator for us. When other people are greedy, we want to be fearful. When people are fearful, we want to be greedy. Ideally, we'd like to be in this medium part, but right now it's just important to know that there is a lot of emotion out there when it comes to our health and well-being, our jobs, our ability to manage our finances, and it's important for us to know just psychologically as investors. Now, those slides may connotate a very bearish or negative outlook. I do want to present this slide, which is a positive thesis on what we're experiencing. And this information comes from a Morgan Stanley research report. Now, the markets and the economy and our attempts to defeat the COVID virus, this is a very fluid situation that changes from week to week, and there's a lot of leaders involved, both at the government level and in healthcare, to help with this. A few points from this research paper that I thought helpful to provide here as we finish up our mid-year review was that renewed social distancing and selective and rolling lockdowns will likely keep outbreaks in check without strict nationwide measures. So that is the hope, is that kind of regional lockdowns, selective lockdowns will help to mitigate what we've seen in the spike in cases of COVID over the last 3 weeks. Most people do not have an appetite to see a complete global shutdown of the economy nationally like we saw in March and April. The second point here is we mentioned that monetary policy was very positive at the beginning of this presentation. And this point adds to that it is expected that policymakers will enact an additional $1 trillion in fiscal stimulus. And it's important to realize as investors that the U.S. Treasury and Federal Reserve are very active and have been very vocal that they will be a backstop in supporting the economy, supporting the markets. Whether that is good long-term is up for debate, but they've been very hands-on over the last few months. And then the last point here is the thought that social distancing is less likely to exert a drag on consumer habits, such as spending. And whereas we may not be spending money on going out to eat at restaurants or on airline tickets, people are diverting that money and spending it elsewhere, such as Home Depot and Lowe's, or doing landscaping or remodeling their house or buying new computer because they're working from home. So that's the thought, is that there's still consumer spending happening. It's just being done in different categories. Either way, it's a very dynamic environment. Our takeaway is we need to continue to be focused on the long term, but also very proactive in how we manage assets for our clients. So with that, in my closing slide here, summary and playbook, we do think current market valuations are at very extreme levels. They continue to be divorced from reality as we enter the third quarter. And we would expect continued market volatility throughout the summer and into the presidential election in November. What we can control, and these are questions we've shared before with our clients, is it's a good time to revisit your comfort level. How comfortable you are with risk. If you were going to rank yourself from 0 to 100, where would you fall? And just make sure that the types of investments you're in, that they fit your overall needs, goals, and objectives. For retirees, it's important to look at how much money you're withdrawing from your portfolio. During volatile economic times, this is really important. The ideal withdrawal rates based on financial planning studies is somewhere around 3 to 5% annually of your overall portfolio. And then finally, for investors of all ages, it's a good time just to evaluate your spending, your budget, your savings. We really recommend you continue to contribute to your employer retirement plans or to an IRA if you have one, or a Roth. This is a good time to be revisiting your financial plan to make sure you're on track, whether you're saving for college or buying a house or retirement, or you just want to be a good steward of your resources. This is a really good time in 2020 to be revisiting that. So with that, thank you for listening to our mid-year 2020 market review brought to you by Authentic Counsel. For more information, or if you have questions about anything we presented here, we would be happy to visit with you. You can go to our website at AuthenticCounsel.com. We'll be happy to, someone from our team will be happy to talk with you on any questions from this or other topics you have. And we want to wish you a safe and happy Independence Day holiday, and be safe with your family this summer. And again, we thank you for taking the time to watch this video. Again, this is July 1st, 2020, and this has been Authentic Counsel's Mid-Year Review. Take care.